Perfect. So today I'm joined by Rado, who's the founder, CEO, and head of research of QuantPedia. And I'm really looking forward to this conversation because we're going to be touching on some of the differences between quant trading and algo trading, more on like the retail side of things, as well as the institutional and professional side of things. And Rado is really the man to have this conversation with, as QuantPedia is a great database of algorithmic trading strategies, and they do a lot of research in terms of true professional algo strategies. So I'll pass the floor over quickly to Rado to do a much better introduction than that, but it's going to be an exciting conversation.
Yeah, thank you. Thank you, Cengiz. Thank you for being here and for the opportunity to have a conversation with you. So just a very quick overview of what we are. So we are a research only company, and we are trying to bridge the academia and professionals. So our goal is we are going through academic research. There are tens of thousands of papers published every year about finance, about anything. And we are looking especially for academic papers that are related to quant trading. So they contain some trading strategy that you can use. We are looking for those. So we are taking those papers, we are reading them, we are isolating the trading strategy, extracting trading rules, then we are backtesting those trading strategies, and we are putting all of that into our database. We are building out of sample tests of those papers, and our reader there can, go through database, review the strategies, review the performance correlations, etc., etc. We have our own portfolio analysis tool, and in this tool you can build multi-asset, multi-strategy portfolios. We are used mainly by professionals, so our clients are mainly hedge funds, mutual funds, family offices, proprietary trading shops, etc., etc. And we are used as a database of inspiration. So our clients, they use QuantPedia to save the time, so they do not need to spend so much time on academic research. They can go to Quantpedia, check out the auto sample performance, and they can very quickly find which ideas they can use in their fund. Because most of the funds are multi-asset, multi-strategy funds. And those are our clients.
Well, that lends itself really well into our topic of conversation. But really, as we discussed, like we want to kind of contrast some of the differences
Mhm.
between retail and institutional. And the one, probably one of the most important attributes of building like a trading portfolio, even amongst retail traders in the algo space, is like how do you build a diversified portfolio where you try and have the most all-weather performance as possible? So, for instance, like many, even retail traders, they won't run one bot. Like most of the good ones will run 10 bots, 20 bots, really to have something which ideally makes money across most market cycles. So, what I think will be really interesting for our audience is to see, like, from your experience, how do people build these diversified portfolios? And there's many different like
Uh,
attributes of diversification that we can touch on, but I'd love to kind of just hear from your perspective, like what do the pros do to diversify?
yeah. So they you can diversify among different things. So firstly, you can diversify among assets. So if there are pros, it really depends. What is your investment mandate? Because you can be the fund which is specialized in equities, and in this case, you cannot trade crypto. So if you are specialized in equities, you trade only equity strategies. But if you are multi-asset, multi-strategy fund, then you can diversify more. So first step is that you diversify among assets. So you try to have strategies based on equities, on commodities, on fixed income, on currencies, on cryptos. So these are like four or five main asset classes which are there. And the crypto is the fifth asset class, and it's very very often traded by professionals. So that's the first layer. The second layer is the trading style. So you can have a trending strategy,
Yep.
which is, trading the long-term trends. You can have a strategy that's trading short-term reversals. You can have a arbitrage or statistical arbitrage strategy. And you have different styles. Then there is a trading frequency. So
Yeah.
you can trade intraday, you can trade daily or weekly. You can have a long-term strategy, something that rebalances monthly. And so it's not just diversification based on the asset. There is diversification based on the trading style. There is diversification based on the trading style. And also, I mean, you can have like the strategies that are built on all of the assets. So, I mean, you have
Yeah.
multi-asset strategies, so they are moving between the assets. You can use the derivatives like options. So, I mean, there are a lot of the layers, and ideally, in the ideal situation, so you are diversified among all of them. So, I mean, your portfolio consists of not, I don't know, 3 or 4 trading strategies, but I don't know, 30 or 40. But of course, there is a drawback. So, I mean, after some numbers of the strategies, it's harder to find the next one which will incrementally add into your portfolio.
Like
So, I
diminishing
mean,
returns.
yeah, yeah. So you will have like added return, I mean, based on the correlation, etc., etc.
Mm.
So most of the funds they end up with some number, and that number depends on their structure. So I mean,
Mm.
as if you are bigger, you need to have the more strategies because I mean the liquidity will not allow you to run just 5 because you are too big for that. So I mean, the bigger the fund, the more strategies they have usually. So because you must be
Makes,
diversified, otherwise you are not able to trade. So.
you won't get filled if you start trying to only run one pair with one strategy with an
Exactly.
enormous amount of
Yeah,
volume.
yeah. Exactly, exactly, exactly. So I
That's
mean,
fascinating.
at the end, I mean, that's the difference between the big funds and retail. So I mean, the funds have a problem with the liquidity. They must be diversified. They must have a lot of the strategies because I mean, yeah, I mean, the markets are big. They are liquid, but if you are a $1 billion fund, I mean, they are not so liquid.
No, and
So.
I know from like kind of my beginner knowledge here, like I've looked at a few funds like Man AHL, which are like commodity
Mm,
trading advisors, and they seem to kind of be specialized in the type of like trend following system,
mm.
whereas like others I've seen are like pure play crypto funds. Like, would you say that it's more common to have funds which do everything in like one fund specifically, or is like specialization across asset class or style more common?
Uh, there is like not something that what there are things that are popular in
Mhm.
asset management world, but it's more about business strategy. So I mean,
Okay.
for those guys, managing money is a business, and it's a competitive business. So you do what you are good at, and you do also what you can sell. So it means, I mean, if you are good at crypto, you tend to stick with the crypto and you run a crypto fund because, I mean, that's your brand. So you build your
Mhm.
brand in a crypto space and people believe you that you are good in a crypto, so we give you the money and you run the multi-strategy fund in a crypto, but you tend not to move, I mean, other assets. So if you are a trend following fund and you trade the futures, I mean, you tend to stay there because you are good there and people believe you that you can trade this well.
Yeah.
And if you are multi-strategy, you build your brand on the multi-strategy. So I mean, it's not about, I mean, what is popular, is more about what you are good at and how do you want to, I mean, position your brand. So I mean, the professionals look at that from the business perspective. So they look at running the fund as a business. So I mean, if you are a company, you need to distinguish yourself somehow. So I mean, there is a Tesla is distinguishing I mean, as a company
Okay. Yeah.
itself from, I don't know, Stellantis or I don't know, Chinese cars somehow. So they are positioning differently, and the funds are doing the same thing.
Okay.
So that's
So
the
if you have a
reason. That's the
certain
reason. Yeah,
if you have a certain pool of institutional investors who might want to be the limited
exactly.
partners, if you know that like there's appetite for a certain type of
Yeah,
like conservative long short fund, you
exactly.
develop that product because you know that people want to go into it. And if that's where your expertise lies, you're more likely to focus on that.
Exactly, exactly. So it's not driven just I mean, from the bottom. So I mean, what are the edges that you see at blah blah, but there is also driven from the top. So I mean, what is like, what you can sell under your brand, and what are your clients looking for. And the clients for institutions are usually the pension funds, high net worth individuals, etc., etc. So I mean, those are your clients, and you are, I mean, listening to your clients, and you are building what those clients want from you. So
It makes sense. You can't, even if you have the greatest product, if it doesn't fit within like
Exactly.
the
Yeah.
allocation mandate of the LPs, like nobody's going to
Yeah.
actually
Yeah.
finance it. And like diversification is a big word too, but like practically speaking, when these funds look to build a diversified portfolio, like what metrics do they look at? Is it just pure correlation, or are they looking for like some sort of proprietary test to ensure that in the event of a crash, like nothing, not everything moves together? Like I think our audience would be really interested to see like
Mhm.
what statistical measures are most widely
Yeah.
used.
So, I mean, the statistical measures, they differ from company to company. So, I mean, there is
Mhm.
like no standard or anything like that. What I can say is that the correlation is a tricky. So, as you
Yeah.
said, I mean, things that seems uncorrelated are uncorrelated 90% of the time. And when you need that low correlation, they tend to correlate. So I would say most strategies can be more or less divided into two groups. So there
Mhm.
are like um, crisis hedge. So the strategies that tend to work better when there is a stress,
Mhm.
and then like pro-cyclical strategies. It
Mhm.
doesn't mean that they are trend or I don't know something like that. It means that they tend to work better when there is no stress.
Mhm.
So I mean, so what our professionals are looking more at is what is the profile of that strategy under the stress scenario, and they tend to put this strategy into one or another bucket. And it's easier to build the strategies that are pro-cyclical. So I mean, the strategies that work when the weather is fine, because I mean it's easier because you can just buy the SPI and you can just hold the equities. I mean this is like very simple buy and hold, or you can buy the crypto. I mean buy and hold or hodl, and it tends to work well. I mean when everything is fine. So it's a little tricky to find the strategies that are that have the crisis hedge
Yeah.
capabilities. I mean it's really hard, but there are some. And what are the professionals trying to do is that they try to build the uncorrelated portfolio from the strategies that are, let's say, performing well when there is no stress. And
Mhm.
then they build like crisis hedge uh, overlay that they hope will make money when there is a problem. So,
Okay.
and you can build it differently. You can just buy the puts, but I mean, it's like expensive. So usually what the professionals are doing that they are running a specialized set of strategies that are, I mean, they do not expect to make money from them a lot, but they expect from them to hedge the whole portfolio when there is stress. So this is how it's usually done.
I think that's certainly a divergence between what retail does and what institutional does,
Mhm.
because I know that in like amongst people I've seen running portfolios of bots, oftentimes people run a correlation, just simple correlation tests,
Mhm.
and they'll see that like this mean reversion strategy will do reasonably well, while this trend following strategy does poorly. But then, like I've been in this business long enough that I've seen times where everything starts to be a bit tricky, and a great example was like Liberation Day
Mhm.
or close to Donald Trump's elections, like a lot of the brokers started widening their spreads. So then, just because they were trying to protect themselves, and effectively what happened was many like more breakout style systems started failing, and there would be no way of seeing this in a historical test because you're modeling based on spreads of, let's say, 5 pips, and then they go to 25 right during the high volatility times. And this happens across indices. And even if you're running a mean aversion strategy and a trend following strategy, or you're going long and short, like you have this exogenous factor of during a panic, like everything changes. And that caused a lot of portfolios to have some harder time. So I was thinking that when we start to kind of look more into what the pros are doing, they must be doing something to hedge against this exact, like
Mhm.
everything's correlated during a collapse environment.
Yeah. I mean, what I see as the main difference between the pros and retail is that the pros has the longer, they use the longer data. So, uh, I mean, you cannot build a portfolio based on the last 2 years' performance, or I don't know, based on one business cycle. By one business cycle, I mean that you are using the data from the past 3, 4 years. There was, I don't know, one stressful situation or one stressful year and 3 good years. and you have the strategy based on that, and you believe that that's a good sample. It's not a good sample. I mean,
Yeah.
what the pros are doing is that they are trying to have the as longest backtest as they can, and they do not do it because they want to see the good numbers. They want to stress test their portfolio. So they want to see, I mean, how it will perform in 2008, in 2011, in 2000, in 2015. So I mean, the stress times. And if they do not have a data, they try to use the simulated data or from or something. I mean, they run a lot of stress scenarios.
Mm.
Uh, so and that's a difference because I mean they have a longer view. They know that it's not hard to build a strategy that has nice 1 year performance or 2 year performance. But what is, I mean, complicated is to build a portfolio that will have a good performance for 10 years. Because
Yeah.
in those 10 years, you will have like 3 or 4 years, which will be extremely stressful. Uh, but I mean, if you have a top-down view and you are using data for 30 years, you can imagine like, yeah, how would that strategy look like if I was in, I don't know, 2001 or something like that. So,
You're building something which is truly robust. Like you're looking at a
yeah,
longer market
exactly.
cycle. Like
Exactly.
you don't want to be happy with your back test. You want to like beat up your back
No,
test as much as possible
no.
because
Yes,
it's better to
exactly.
be pleasantly surprised than disappointed when you have live money and particularly when you have clients' funds at stake as
Yeah,
well.
yeah. And
So
there is your
that
name in a stake. Exactly.
yeah, reputation and oftentimes like you're licensed as well. So it's there's no room for silly errors. You want to make sure you're as robust as possible. It lends itself really well, this topic, to our next kind of subtopic of our chat today, which is like risk management at the pro level versus the retail level. And this is something which like retail traders love to talk about risk management. And it's always seen like even in courses and educators like always start with risk management, which is great in like in theory. Like, yes, I would generally agree with that principle. However, what's seen as risk management by retail traders is oftentimes not as strong as what's seen as risk management at the professional level. Like to give you an example, the almost the holy grail amongst basic retail trading courses would be risk 1% per trade or risk 2% per trade. And once you get into considering other factors like trade frequency or correlation among strategies, a lot of those like simple heuristics go out the window. Because if you're risking 1% per trade, but you're taking 50 trades a day and they're all correlated, all of a sudden, like your 1% risk management rule is not particularly strong. So that's why like I'd be really curious to see like obviously like with good retail traders they're not doing that either because they understand factors like correlation, frequency, etc. But I'd love to hear a bit more like when professionals approach risk management, like what's their general mindset when they're building portfolios? How do they think of risk and how do they manage risk more broadly?
Yeah. So here I think is what is different between the retail and professional. So for professionals, what is the risk? I mean, for professionals, the usually the risk is the maximal drawdown. So they are taking the strategy, or they are looking at the strategy and thinking about, firstly, they backtest the strategy itself, and they are looking for a situation when the strategy had a drawdown, so a series of, I mean, bad trades,
Mhm.
and what was the maximal drawdown over that period,
Mhm.
and then they are asking whether that's really the worst kind of situation. So,
Mm.
is it the worst drawdown that I can have, or can I have, I mean, even the worst drawdown? And they are, I mean, so they are looking at the risk from that point of view. Because I mean, this is your actual drawdowns. I mean, this is your actual risk. So how much money you will lose? Because I mean, when you start trading, you can start trading exactly at the top of the at the top on an all-time high,
With equity
and
curve
over the
then.
next,
Mhm.
yeah, exactly, and over the next months you can lose that. I mean, the maximum drawdown which is there, and you can lose even more. So I mean, that's the risk. So they're looking at it from the drawdown perspective. And then it depends, and also it depends. And then they are also looking, I mean, on the from the perspective of the value of the risk. So and I mean, there are like a lot of
VAR.
different yeah, VAR. I mean, there are a lot of the different calculations of how you can calculate all the VAR of the, I mean, value at risk, etc., etc. But I mean, what does it mean is that on every month or every day or every hour, what is my actual position
Mm,
and how much I can lose in case there will be some stress. And they
mm,
can define the stress, I mean, differently, like 95, 97, 98%, etc., etc. And it's not because, I mean, you want to, it doesn't mean that you will lose, that you cannot lose more. I mean, you expect that you can lose more, but you need to know, I mean, where is the level at which you will start cutting your portfolio, and I mean I mean, what is like under the ordinary situation, when the stress will come to the market, what is my exposure? So I mean, the VAR is about the exposure. So you want to know what is your exposure, because you can have a great, I mean, I will give you an example. I mean, this is best for
mm,
so I can have a strategy. The strategy is running great. Is using the I don't know, futures, S&P 500 futures, and I'm
mhm,
trading with leverage 10 to 1.
mhm,
And I have a great strategy with the drawdown, I don't know, 5%, whatever. I just figured it out. However, I'm having the overnight positions. And what
mm.
is my maximum draw? What is my, I mean, maximum risk? Is it the 1%? I mean, per account, or I mean, it is my maximum drawdown? No, if I'm running the 10 to 1 leverage, I mean, my maximum risk is the 1987, because in 1987 there was minus 20% drawdown. And
Yeah.
if I have an exposure in overnight position, 10 with leverage 10 to 1, what I can lose, I mean, in the worst case scenario, is 200% of my portfolio. So this is my actual risk. So this is my
Mm,
value, this is my exposure. And yeah, it happened in the past, and it can happen in the future, in the next 20 years, someday, somehow, maybe. And they are looking at this. So they are looking, I mean, what is my risk in the ordinary situation, and what is my like risk in the stress situation. And they are trying to build the portfolios in a way that you will not breach uh, in the normal situation, you will not breach something, some levels, and in the not so ordinary situation, that you will be able to, I mean, come to your clients and tell them, yeah, we lost you money, but we have not lost you all of the money.
we survived. I always
Yeah,
remember
we
like
survived.
the Euro Swiss franc depegging as kind
Yeah,
of
exactly,
the example in my
exactly,
mind, where it's like
exactly.
everybody thought that like, yes, I have a stop loss, fantastic. My position, like how
Yeah,
bad can it? But
exactly. How
then
bad it
like
can be.
it moves within a certain like a very small variance of each other. But then like something happened and tons of brokers went bankrupt. I think FXCM needed to be bailed out, and that's when they got sold. So stuff can happen like that. You just have to be mindful of it. Something which I'd be really curious to ask you too is when they look at a max drawdown, like let's say you run a basic
Oh,
portfolio, you come up with a max drawdown. Is there like a multiple which they apply to it, or do they Monte Carlo it but beyond a certain amount? Like that's typically what I've seen a lot in retail trading is you'd run a portfolio, let's say you get a max drawdown of 6%. You then run 1,000 Monte Carlos and look for a certain confidence interval and say like,
mhm.
okay, if we're at 15% under the worst possible 99.9th percentile, we're still reasonably robust. And if my drawdown was two or three times more than what I'm seeing in this back test, I'd still be relatively happy. Is there a similar approach which is applied by the institutional guys? Is it a far more sophisticated approach, or how would it kind of contrast or compare to the more like retail approach?
Yeah. So what I can say to that is that I was very big fan of Monte Carlo in the past, and I was doing all of the Monte Carlo. And at the end, I realized that, I mean, on average, when you when you see 100 strategies and you do Monte Carlo on 100 strategies, and then you take a look on out of sample performance of that 100 strategies over the next 1 or 2 years, you will see the pattern. And after a while, you do not need to run the Monte Carlo because you have like idea in the mind how it will look like. And I will tell you, I mean, what is my formula? So my formula is if I have a backtest, and in the backtest I have the performance of, I don't know, 10% and draw down 10%. Uh, I expect from that strategy out of sample to have the performance of approximately half and the risk approximately twice. Because
Mm.
this is what will happen. Yeah, it doesn't mean that it will happen to every strategy. So, but on average, out of sample, you will have like half of the performance that was in the backtest, and your risk will be twice. So this will be because all of the backtest, I mean, you can do anything in your backtest. You can try to be as it is possible to be without the bias, etc., etc. But I mean, at the end, you are still including some biases into the backtest,
Mm.
even by, I mean, picking just, yeah, this is the version of the strategy, and maybe it's not the best version, but I mean, I tried like 20 strategies and I picked one. And yeah, there is already a bias there. So, uh, so I mean, when you start running the strategies live, you will probably see that from all of the strategies, they have like half of the performance that they had in sample, if you are lucky on average, and they are like twice more risky. But what does it mean is that when you are building the portfolio, you can work with that.
Yeah.
So if you build a portfolio and you know that every strategy will be, I mean, have these parameters, and in the portfolio you are still okay with that because you have 10 strategies and they are uncorrelated, then it's fine. Then it's okay. So, but this
I
is
do
what will
something very
happen.
similar. I'm like, if my
Yeah.
drawdown was double and my return was half, would I still be
Yeah,
happy? And then,
exactly.
so I'm glad that we're on a similar page there
Yeah,
because yes, you can Monte Carlo it like crazy. You can do all of these
exactly.
stress tests, but as long as you see that like, and then you can even take that further. You can say if my return was a third of the
Mhm.
portfolio and my drawdown was triple, would I still be happy? And
Exactly.
if that's reasonable, then I think I'm fairly confident in running it. Whereas, like, so that's why if people, oftentimes in retail trading, they'll build portfolios and they'll solve for a max drawdown. And I think like being more conservative than
Mhm.
less is
Yeah.
so important because then you can withstand. And the biggest thing is you also have time to withstand a drawdown and you can interfere if needed. So, like, let's say, for instance, if you have more than 10 losers in a row, your portfolio goes super, super deep into drawdown.
Mhm.
And then all of a sudden, like if you have a bad week, you're going to be panicking. Whereas if you need to have like you Monte Carlo it, you to get something which is a meaningful drawdown, you need to have a enormous, enormous losing streak that gives you some time to think. And you can go and you can look at your back test, you can look at your stress test and say like, are we still within a reasonable interval where we don't have to make any brash decisions? Whereas I find if
Yeah.
folks over leverage, they don't have time to think before something might be broken. And it lends itself well as well to another question I had for you. Like, what kind of return magnitudes would you see these funds shoot for? Like, are they optimizing for drawdown and then whatever return they can get within those drawdown parameters is their target, or how do they kind of approach the performance targeting?
Yeah. So it depends. It depends if your benchmark is relative or absolute. So I mean, if you have the relative benchmark, so I mean, you try to have the better performance than, I don't know, S&P 500 or whatever this is your benchmark, and you are trying to, so you are not building your strategy based on the absolute drawdown, but on the relative drawdown. So I mean, you do not want to have like bigger tracking error than 20% or 10% from the index itself,
Hmm.
and you want to have alpha, some amount of the alpha,
Sure.
or you are, I mean, your benchmark is the absolute, and in this case, you are shooting for absolute performance, and you want to have like maximum drawdown somehow. I mean, what is the biggest difference between the retail and professional is that the professionals have the money, so they do not need big returns. They are on the other side, so they are more afraid of losing those money. No, on the other hand, what I see in the retail is that they are trying to over leverage their portfolio, so they are shooting for 30% annual returns or something like that, and they think that they can stay with the portfolio that will have 50% drawdown or 40% drawdown, which they will not. So, so they think that they are risk averse, but they are not risk averse. But they do not have, I mean, big portfolio, so they need to have big profits. But
Mm.
on the other hand, I mean, how the professionals are building portfolio, they are looking for steady returns, and
Mhm.
they are, I mean, happy with 10% returns annually on average, if the drawdown is up to 10% plus or minus. So that's what
Mhm.
they are looking. So this is like the, let's call it, happy number. So I mean
Sure.
so it means that the performance to drawdown ratio is plus or minus around the one. So if you have the fund with those numbers for over, I don't know, 5 to 10 years, you are one of the best of the best. So I mean, everybody will be happy after the, of course, after the fees. So that's what
Yeah.
they're looking for because as you said, I mean, the future will be probably, so you can hope for the best, but you need to prepare for the worst. So I mean, so
Right.
the future, there is not zero probability that the future will be worse than the past.
Mhm.
So I mean, if in the past you were okay with the 10 or 10, 20%, in the future, maybe there will be 40% drawdown. So you cannot over leverage yourself a lot. So that's the difference. So I mean, in the professionals, I see that they are mainly focused on not losing the money, and then
Mhm.
they are focused on making the money because at the end you will make money only if you will stay in the business.
I think it's a
But on the
Warren
other,
Buffett saying, like rule number
yeah,
one, don't lose money, or Charlie Munger, that was the,
yeah, yeah,
then like
yeah.
rule number two
I
is
know
don't forget rule number one.
exactly. I know. Everybody is talking about it. Everybody's talking about it, and even me. I mean, when I heard that 20 years ago when I started trading, it was like, yeah, okay, that's. I mean, everybody's talking about it. But I mean, after 20 years, you realize that, yeah, it's true. So the future is more messy and more risky than you can imagine. So, I mean, you need to build it in a way that you will survive, firstly, and then you can think about making money.
No, it's a really interesting to kind of contrast the mindset and the mentality of the two groups. And from what I've seen, like I came from an institutional finance space, granted more in the private equity side of things, and the kind of coming into the retail space afterwards, it was really interesting to see just the magnitude of returns that folks were shooting for. And like we were doing infrastructure investments where like 9% unlevered was phenomenal because then you can juice it to like low teens. Whereas when you go
Yes.
into the retail space, you have folks who are like, we want to make, like I once spoke to a guy who wanted to make 2% a day. And it's like if you're
Yeah. Good
shooting for
luck.
those returns, like yeah, me too. We're gonna have a money printer if we do that. And it's a completely different mindset, but you see where folks come from. If you don't have a lot of money, you want to really magnify it. And I think like finding this happy middle where perhaps you can be a bit more aggressive because it's your own funds, but at the same time, not over leveraging enormously so that you don't have catastrophic risk is
Mm,
also like essential. So maybe for our last kind of subtopic, something which is really interesting to me is when you're building these portfolios, like market regimes shift. And ideally, if we build something which is robust, we can survive the different changes. But something which I've kind of seen in my journey is like, how do you know if a strategy is broken? And that's also something which, as a strategy seller, people like will have varying opinions on this. And I can know that, for instance, with my test, I'll always look at historical back tests and see what is the max amount of losers in a row which we had. You can apply standard deviations to it, and you can use some of these statistical measures to get an idea if something is still robust. And frankly, I find that people oftentimes are too premature to think something is broken. Like a strategy will have three losers in a row, whereas in a back test, it might have 20 losers in a row. And people will start to panic due to
mm,
usually over leveraging. But just out of personal interest, and I think for our audience as well, like what are some of the metrics that pros use to know, okay, maybe this edge is gone, maybe we've degraded it, and perhaps it's better to swap it out for something else in a portfolio?
mm. It really depends on the strategy profile. Uh, I mean, really, really. So, uh, I mean, it is different when you have the like CTA strategy,
Mm.
which is using the medium to long term trends, and I mean diversified among 20 different assets or futures. I mean, it's like those are like classical CTAs that
Yeah,
Winton is, for example, running, etc., etc. So
yeah,
for something like that, to know that the strategy is broken, it would take years. I mean, like 2, 3, 4 years. And it still doesn't mean that strategy is broken. I mean, it still can mean that it's underperforming because the macro environment or whatever. So there are always like these ebbs and flows about, yeah, this is the time for the value, or the value is the dead, and 5 years the value is dead, and after 5 years there are like 2, 3 great years for the value, and then everybody's talking about the value, and yeah, growth is dead, etc., etc. So it's very hard to say which strategy will survive and which not. So what I can say is that there are some kind of the strategies for which you would have to trade that strategy 20 years to see whether it works or no.
Mhm.
And there are like low Sharpe ratio, let's call them factors,
Mhm.
like value, momentum, trend
Sure.
following, volatility premium, carry, etc., etc. So I don't premiums.
Mhm.
And for that, the professionals take a look on them that they will never die. They try to be diversified among them because they can be long periods when the strategy is not performing well. What you can do in this kind of scenario is that you can build your portfolio. So you have
Mhm.
like 20 strategies and you decrease the weight of
Mhm.
those that are not performing well, and you increase the weight of those that are performing well, but you never remove those
Mhm.
unperforming.
Interesting.
Like the value, you do not want to remove the value just because it was not performing well last 3 years. You cannot say
Mhm.
that it's dead. You can decrease the performance. Sorry, decrease uh, the weight,
Mhm.
and you can tilt your portfolio. So what you are actually doing is you are running like momentum meta strategy. So you have like
Mm. Okay.
you are checking how are all of the strategies performing, and those that are performing well over the last 6 to 12 months, you will give more weight to them because you will expect that they will continue to perform, fine in the next quarter or next month. And there are actually research papers that show that this is a valid way how to do that.
Hmm. Okay.
Uh, so and then there is like a second kind of the strategies, which are more, let's call them arbitrage like.
Mhm.
So they are usually very short term, and they are really mining inefficiency,
Mm. Okay.
some short-term inefficiencies or something. And they have the advantage that usually they have a lot of the trades.
Mhm.
They are quite with a high frequency. It does By high
Mhm.
frequency, it doesn't mean that they are trading on milliseconds basis. What does it mean is that they have a lot of the trades, and they are easier to mm, from the statistical point of view, because you will have a lot of the trades, and if the last, I don't know, 1000 trades show that your edge is shrinking, you will see it in your data. So you will see that, yeah, our edge is going down, 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 down. If you have smaller and smaller edge, and our edge is decreasing, so it means that we need to find something other. In
Interesting.
this kind of the situation, what are the professionals usually doing is that they run a research. So
Mhm.
they are running a pool of strategies, but they have other strategies that are already researched, and they are waiting to, enter the pool. Ideally, when you remove one strategy, you already have another one that you can, put there. But
Okay.
usually, once the equity curve starts to flatten out, you know that, okay, either that strategy is all not, or do not have the edge, or secondly, you already, it's already entering, let's call it the factor space. So it means that
Sure.
everybody knows about the strategy. It's not a strategy with Sharpe ratio of 2.0. It's something that's well known, and it's a factor. So it means it will never disappear, but it's more correlated with other factors, and it will have Sharpe ratio 0.3 in the next three
Mhm.
years, 5 years, 10 years, whatever. So
So you're
you need
getting
to,
paid less for alpha and more for just taking on risk premium at
yeah,
that point. And
exactly.
you're just
Yeah, yeah,
you're capturing something. And I guess with in terms of the arbitrage strategies mentioned, like the kimchi trade, I think is an example in crypto. Whereas if there's a clear difference between, I believe they were doing like a tri arbitrage strategy between an exchange in Korea and a couple of exchanges in the US. And for a few years they were just printing money because it
yeah,
was a clear inefficiency. But then like the spreads like eventually dissipated because enough people were doing it that it was a
exactly.
basic like locational arbitrage, and it will shrink when there's more sophisticated players going to it.
Yeah,
But the equity curve
exactly.
smoothing is a really interesting test. So I imagine, do they ever use like slope tests on the actual equity curve, or is it more like is it just something which you'd observe? Like if your profit is like
Yeah.
you're not making as much per trade, etc.
Yeah, I mean, yeah, you can definitely, I mean, put the numbers on that. So you can have something like, I don't know, moving average of the profits or something like that. I don't know. And it really depends. It really depends, I mean, how fast the strategy trades. So it's
Hmm.
different,
Okay.
as I said before. So, I mean, if you have like, but now we are talking about really real professionals. So, I mean, if you have, I don't know, 1,000 trades in a month, 1,000 trades in a month, and you are trading month by month by month, and you see that, I mean, your profits are shrinking. Yeah, of course, I mean, some of that can be related to volatility. So, I mean, if there is you can expect that if there is higher volatility, you have more, I mean, higher income because there are higher spreads. When there is lower volatility, you will have less income. So, I mean, you can uh, incur some of that losing of the profit to low volatility. But I mean, if you remove that part, so it means if you get away all of the macro factors and you still see that your edge is shrinking, it means that, I mean, your strategy is losing the edge. So
Hmm. Okay, no, that's so fascinating. I think we're coming up to time here, so I just want to thank you so much for taking the time to chat with our audience and myself today. Like, this was an incredibly insightful conversation. I personally learned a lot, and maybe is there anything else that you'd want to just wrap up on for our audience and for our viewers?
so I would probably just once again stress the leverage. So yeah, what I would say is you can expect that the future will be worse than your backtest. So the mistake number one I see in a retail trader is that they structure the leverage based on the backtest. So if there was a drawdown 20%, they expect that the drawdown in the future will be 20%, and they base the leverage based on that, or even better. So I mean, they expect the drawdown will be 10%, and they build the leverage based on the 10% drawdown. And this means that they will be over leveraged because the
Mm.
future will be definitely worse. So I mean, do not do this mistake. I mean, really, really, it's a mistake. So the future will be not so good as in the backtest. So you need to be conservative, more conservative in the real
Yeah.
life.
Always assume that the worst is yet
Yeah,
to come in
yeah,
trading, and it's better to
yeah,
be pleasantly surprised than like
exactly.
have a nasty surprise. So
Yeah.
for everybody watching, we're going to film another video from the other perspective where Rado's going to ask me a few questions about the retail side of things. So if you're interested in watching that video, we're going to link it in the description, as well as we're going to link some amazing resources from QuantPedia if you guys would want to check out all the great work that Rado and his team is doing. So guys, thank you very much for watching our video and hope you enjoy the next video, which will be on Rado's channel. Cheers.